Important note, this video is not financial advice. Always do your own research before making any investment decision. Past performance does not guarantee future results. Here's your market briefing from Rumour with AI. Bank lobbyists have successfully derailed the Clarity Act, a move designed to protect deposit yields from stablecoin competition. JP Morgan and major banking interests blocked the legislation, ensuring that low bank deposit rates remain unchallenged by the growing stablecoin market. This occurs despite record banking profits, highlighting a strategic effort to maintain the status quo in financial intermediation. Meanwhile, Saudi markets are breaking out. The Tadawul all-share index rose 0.89% to hit a new one-month high. Media, publishing, energy, and insurance sectors led the charge on Sunday, signaling broad-based confidence in the kingdom's economic diversification efforts. On the macro front, climate risk is no longer a peripheral concern. Moody's estimates that last summer's European heat waves inflicted a $50 billion hit on economic output. As the S&P 500 dips 0.2%, investors are rapidly assessing climate risk premiums across sectors. Capital is beginning to price in the tangible costs of environmental instability. In related news, the global oil market faces a paradox. Prices are rising even as global demand collapses. This structural shift threatens energy market stability and undermines current economic growth forecasts. The disconnect between price action and fundamental demand signals a deeper crisis in energy consumption patterns. Trade policy is also shifting. The Trump administration is processing up to $2 billion in tariff refunds for corporations. This marks a significant pivot in trade enforcement, offering immediate liquidity to affected businesses and potentially easing supply chain pressures. Looking ahead to today's release, the economic calendar remains relatively quiet with no major high-impact data points scheduled. However, the absence of fresh macro data amplifies the weight of these structural stories. Investors are left to digest the implications of regulatory protectionism in banking, the tangible costs of climate change, and the evolving dynamics of global energy demand. The narrative is clear. Financial regulation is being shaped by incumbent interests rather than innovation. Markets are reacting to both geopolitical shifts and environmental realities. The $50 billion climate cost is a stark reminder that physical risks are now financial risks. Similarly, the tariff refunds suggest a pragmatic approach to trade, prioritizing corporate stability over strict enforcement. Oil's structural demand collapse is perhaps the most concerning signal. It suggests that previous growth forecasts may be overly optimistic. Energy companies and investors must prepare for a lower demand equilibrium. The Tadawul's performance offers a counternarrative of growth in emerging markets. It shows that capital is still flowing into regions with strong sovereign backing and diversification strategies. As we move through the day, watch for any updates on the Clarity Act's aftermath. The banking sector's victory is temporary if regulatory pressure mounts. Similarly, monitor oil inventories for signs of further demand deterioration. The market is pricing in a world of higher climate costs, shifting trade policies, and entrenched financial interests. These are not transient events. They are defining the next era of global economics. That's your market briefing. Follow Rumour with AI for daily market intelligence.